Another day, another story. Hello, and welcome to Money Makes and Money Breaks, where we ensure you are entertained within the financial sector with eyes wide open. Please remember, this is not advice of any sort, so please conduct your own due diligence. In this episode, we will dig into the unfortunate but expected events that have occurred in this past 7 days, which led to the collapse of 3 major financial institutions. Did someone say déjà vu? In a shocking turn of events, Silicon Valley Bank, one of the biggest names in startup lending, has collapsed. It's like losing the golden goose of Silicon Valley, if the golden goose was in the business of loans instead of laying eggs. But let's not mourn the loss of Silicon Valley Bank just yet. Instead, let's take a stroll down memory lane and recount the major events that led to its downfall. March 8th was a doozy of a day for banks, with Silvergate Capital announcing that it would liquidate its assets after a bank run forced the crypto-focused bank to sell its debt securities. Meanwhile, Silicon Valley Bank was scrambling to shore up its balance sheet and raise $2 billion in capital. It sold a bond portfolio at a whopping loss of $1.8 billion, and Moody's, the credit rating agency, downgraded its bond rating and outlook to negative, from stable. Not a great day at the office for the bank, to say the least. The next day, during a conference call, Silicon Valley Bank's CEO, Greg Becker, urged venture capital firms to stay calm. But investors on social media were in full panic mode. Even Bill Ackman, the billionaire investor, suggested that the bank might fail and require a bailout. A Silicon Valley Bank executive wrote to clients that the bank was actually quite sound, but when has that ever stopped investors from tweeting otherwise? On March 10th, the day of reckoning arrived, and Silicon Valley Bank failed after a run on deposits. The regulators, being the California Department of Financial Protection and Innovation, DFPI, the Department of Justice, DOJ, the Securities and Exchange Commission, SEC, Financial Industry Regulatory Authority, FINRA, and the Office of the Comptroller of the Currency, OCC, to state a few, swooped in and took over the bank, with the Federal Deposit Insurance Corporation, FDIC, named as the receiver. It's the largest bank crash since the 2008 financial crisis, and nearly $175 billion in customer deposits is now under the regulator's control. To prevent the contagion from spreading, regulators also seized Signature Bank, which had 40 branches and lent largely to real estate companies and law firms. It's like a domino effect, but instead of dominoes, it's banks, and instead of falling over, they're failing spectacularly. But don't fret, dear reader, for the government has assured us that no losses from either bank's failure will be borne by the taxpayer. What a relief! It's not like we've got anything else to worry about in these affordable times of no inflation. President Biden even gave a speech to reassure us that the US banking system is safe and sound, and that taxpayers won't be paying for any bailouts. Well, that is certainly a weight off our shoulders. And to cap off this wild ride, the Justice Department and the Securities and Exchange Commission, SEC, have reportedly opened investigations into the collapse of Silicon Valley Bank. Who knows what they'll uncover? Maybe it was all a scheme concocted by a rival bank or one concocted from within. Are there government officials involved? Or, maybe aliens took over the bank's headquarters and forced everyone to make terrible financial decisions. We may never know, but one thing's for sure, Silicon Valley Bank's collapse is a cautionary tale for all those who dare to enter and trust the banking system. I hope you enjoyed this episode on the potential trigger to another great recession. Please remember, this is an entertainment and comedy of finance channel and should not be taken as fact or advice in any format. Thanks for watching.